Hi, I'm here today to share with you a bit about angel investing, what it is, who does it, and how you can get involved. I started my angel investing 25 years ago while I was building a software startup in Silicon Valley. Back then, we didn't know it was called angel investing. It was just sort of the thing that you did. I was a young man building a high-tech company in the throbbing, beating heart of the global technology community. Startups and entrepreneurship were nowhere near as mainstream as they are today. I came back from that experience. I came home to Australia and I initiated the organised angel investor community. 15 years ago, I founded the Melbourne Angels, and today I still represent Australia in the international angel community. I chair the Asian Business Angel Forum. I'm a trustee for the Angel Resource Institute in the United States. I'm involved in a number of other international angel organisations, and I have trained thousands of people in angel investing across 3 continents. An angel investor, to me, is a person who invests his or her own money and time in an unlisted growth company as a personal decision with the objective of realising a capital return in the foreseeable future. Unlike passive private investors, angel investors are distinguished by their commitment to invest both financial capital and intellectual capital, money and time. Proactive contribution of intellectual capital is key to mitigating the risk and promoting success. If we can't contribute intellectual capital, then we won't invest our financial capital. Angel investing is an exciting and rewarding way of investing in startups. It is a personal, proactive investment in alignment with the founders. Imagine being a foundation investor in a technology company that delivers a cure for diabetes. That's a real Australian company right now. Imagine as an angel shareholder, your advice helps the company succeed with a universal payment system that has all the convenience and security of credit cards, none of the fees. That's an actual angel-backed Australian venture. Imagine you invested in a startup just as it started to scale its revenue, and then 6 years later, the company sells to a global corporate, giving you 10 times your money back. Angel investing is being a proactive participant in that entrepreneurial adventure for a whole bunch of startups. But why? Why do we need startups? Why invest in startups? Why take all of this risk? Everyone wants the world to be a better place, and everyone is looking to the change enabled by radical innovation to lead us out of our troubles and into that better world. Startups are designed to succeed at radical innovation. To offset the risk and the high failure rate of startups, you will need to build a portfolio of at least 10 concurrent investments. A portfolio is important because startup investments are illiquid. That is, you are usually locked in for the entire journey until the company is sold. You can reasonably expect that at least half of everything you invest in as an angel investor will completely fail to return any cash to you at all. This is all about the high risk and the high reward. Angel investors align themselves with the future success of founders because the rewards to founder shares and the rewards to angel shares are very likely to be very closely aligned by the time an exit comes around. So if you are a founder seeking powerful aligned investment, please reach out to Melbourne Angels now. We'd love to talk to you. If you're an investor, what should you expect to get as your rewards from angel investing? Financial returns, of course. That's what investing is all about. However, all the most successful angel investors that I know all around the world are more focused on other metrics of success. The personal satisfaction of contributing to the growth and improvement of our society, or paying it forward by creating new, well-paid jobs within our own communities. And frankly, there's a lot of fun to be had as an angel investor. The reward of working in the camaraderie of a diverse group of good people with shared values doing good things together. Simple joy of using what we know and we've learned throughout our careers to help others create new value. Intellectual challenge of seeing the world differently through the eyes of a visionary founder. the satisfaction of disrupting the status quo to change the world for the better, and simple appreciation that you will receive from the founders for your valued involvement in their ventures. Still, we have to think about the money. My first angel investment was last century, as I told you, and it delivered a 100 times return. That is, about 4 years after I invested, I sold my shares. I got back 100 times more money than I invested. My first angel investment this century returned 34 times after 10 years. And in the noughties, I co-founded one of the best performing VC funds in Australia, and that returned 8 times in 5 years. Every company in which you invest must be exposed to the risk of success. Our job as angels investors is not to find all the reasons why a venture might fail. Any 12-year-old kid can say it will fail and most likely be right. After all, in excess of 75% of all new ventures fail, and that's even higher in high-growth startups. No, the real art is to see the opportunity for success and a credible path to exit. Anyone with a passion, time, and a modest financial capacity can be an angel investor. Angel investing is for women and men, young and old. Some will have deep expertise, others extensive experience. Some will have a fresh perspective, and others a youthful positivity. Many, like when I started, are still working full-time. Others may have sold their own businesses or retired from their primary careers. Most angels are people who have built or are building their own success, which gives them the confidence to guide others. But you don't have to wait. Some of the most valuable insights for the best investment decisions come from those angels who are embedded in the relevant markets or customer experiences. You should develop your own angel investment thesis. Your thesis summarizes the key parameters and constraints you choose to define your approach to angel investing, the elements that you believe will deliver the best chances of success for you. While every choice is yours to make, there are some factors that connect choices together, some research and data that can inform your choices, and some perspectives that will shape the expectations you have as a result of your choices. So your base investment thesis may consider these issues. What is your purpose? How do you intend to go about your angel investing? And where will you focus that effort? What's your capacity to invest, both in total and how you'll do that on a deal-by-deal basis or across your portfolio? How will you take ownership in the companies in which you invest, or will you choose to be a debt provider instead? And is it important that you're involved with these companies for, during, and after your investment? Would you like to lead the deals, or would you rather someone else took that rather difficult role? And how much time do you have to give to this endeavor? And who will you do it with? Will you invest in each company just once, or will you invest in these companies time and time again? And when it does come time to reap the benefits, how are you going to influence the exit? What do you expect of the exit? Where it'll be, how big it'll be? These are all just the considerations that you will have to make. But none of these are immutable limits. They provide a guide for good investment discipline. When you join an angel group, like Melbourne Angels, at least some of these parameters will be set by the group focus and the group process. At Melbourne Angels, most of our investments are in pre-revenue startups, and we are sector agnostic. However, we have learned over time there are some investments our members simply don't want to consider. For example, gambling. The trick to looking at sectors in early stage investing is not to follow trends. Trends are backward-looking phenomena. As early stage startup investors, we must anticipate the market, not follow it. Startups typically take at least 2 to 3 years to be ready to meet the market. In fact, research shows that market timing is the #1 reason for both the success and failure of startups. Your thesis will help you to know what you want. Then you'll need a process, a way to source deals in what is a very noisy marketplace. quickly filter and evaluate those opportunities to be a good fit for you and your thesis. Know what you consider reasonable terms for investment and have a way to stay engaged. Rule of thumb, you need to touch 50 to 100 initial opportunities to find one that is the right fit for you. Contemplate the angel investment life cycle. The way I've just outlined, at the very beginning, you have to find those deals. Now, for any individual deal, from the time you first contact the founder, the time that you make a commitment and put money in the bank as an investment, it's probably going to take you somewhere between a couple of months and 6 months. It could take longer. It probably shouldn't. However, during this phase is when you have the most influence over the shape of the opportunity, the shape of the investment terms, and frankly, the chances for you to get the returns that you're investing for. But once you've finished that and you are invested, now you come to the longest period of time, holding your investment as a shareholder and finding ways to help the company grow, to support the company, and probably to reinvest in the company over time. Eventually, you finally get to the reward, the chance to reap the benefits that you've been looking for by exiting the company. Usually that'll be because the whole company has been sold, but there are many other models that you might consider. What you will have to understand is that an exit is not just a point in time. Of course, it does culminate in a transaction, but even an exit is a process that will take time. You may have some skills, networks, contacts, knowledge that can help the company create and navigate its exit path, or you may be passive at that stage of the investment. So let's work through that from the beginning again, just a little bit. When you're looking for deal flow, it's a combination of hunting and fishing. When you're hunting, you go looking for what you want. When you're fishing, you dangle a lure and wait for the fish to take the bait. So when you're hunting, you're using your investment thesis to go and target the things that really work for you. When you're fishing, you're waiting for those opportunities to come forward. And where will they come from? Well, when you join an angel group in particular, you get the advantage of the brand. The group has a website, it's active, it's known, it's got many members, it's working within the startup ecosystem. Of course, you can find opportunities depending on what you're interested in from universities, from accelerators. You can find them from other investors who choose to have you as a co-investor. And of course, there are many advisory firms, accountants, lawyers, wealth managers, family offices, all sorts of opportunities to network and find the deal flow that you're going to find. However you do it, it will take a substantial amount of effort. Now, once you start meeting these companies, of course, you're going to have to give them an answer about whether or not you want to move forward in talking to them about the opportunity to invest. The single most common answer you're going to give is no. The next answer you might be giving is, well, no, not right now for these reasons, and maybe yes when things change. So please come back to me. Ultimately, the one answer that the founders and you are really both looking for is the one that says, I'm really curious about what you're telling me. Let's talk about it some more. Now, triaging your opportunities quickly against some of your really core elements of your investment thesis is going to be absolutely necessary. Which elements? Well, they could be the quantum of investment, the valuation, the sector, the geography, or even the team, among all of the others you have to choose from. It really depends on what you consider the real deal breakers. Once opportunities get through your triage, you'll probably want to get a pitch as a first quick way to understand more about the opportunity. I teach founders and investors about the 3 C's of pitching. First is confidence. A founder has to be confident in what they're doing. And in giving a pitch, they have to engender in you confidence in their opportunity, in their solution, and probably most importantly, in them, in the founder and the team. And one of the best ways that they can do all of that is to be very confident in what they're saying, confident in their knowledge, confident in their vision, and to do all of that with the second C, which is clarity. Clarity is that delicate balance between going into all of the details and being brief enough to give us a quick rundown. So the challenge of clarity is that the founder in a pitch has to go from the beginning to end of their story, making sure we learn all the really important things that there are to know along the way, even if we don't get all of the detail attached to all of those. For many people, this is the hardest job to do, but it is also one of the most critical skills to develop if they're going to be successful in sales, they're going to recruit the right staff people, the right channel partners, and in fact, additional investors. So if they can act with confidence and through clarity engender confidence in us, then ultimately the final goal of the pitch is that curiosity that I talked about before. We want to get to the end of the pitch going, wow, that was a really good pitch. I have a great understanding of what it is you're doing, or at least I think I do. I want to ask you a bunch of questions. You're not usually eager to ask a bunch of questions about a pitch you didn't understand at all, or that doesn't get you excited about the opportunity. Once you start asking those questions, you're basically moving into the due diligence phase. Now, I would say that every due diligence you will ever do as an angel investor has already started. Why do I say that? Because due diligence is a process of validating assumptions and verifying claims. And doing all of that relies upon your own knowledge, experience, and expertise. Most angel investors do not use third parties to conduct due diligence. And those rare occasions when you do need some expert input, that is when your own networks will be most valuable. To do due diligence, you'll inspect the business plan, interview the team, review the company documents, accounts, and if they exist, speak to customers and to competitors. But for startups, there is always a paucity of information, a lack of really hard evidence, and enormous uncertainty. Now, if the information is scarce, the analysis indefinite, the conclusion subjective, and the quantum of investment relatively modest, why do any due diligence at all? Because research shows that due diligence has the single biggest impact on your returns of all pre-investment activities. Too little time on due diligence is strongly associated with the worst outcomes, while the strongest returns only happen after a substantial due diligence. Working in an angel group is one of the best ways to access the time and breadth of resources required to do good due diligence. It is worth remembering that angel investors are not investing alone. So good quality due diligence is a key enabler to co-invest. And similarly, due diligence is an excellent tool for constantly validating your own investment thesis and thus further enhancing your reputation as a professional and astute investor. Once you've finished due diligence, you'll have the information you need to shape the investment terms. Now, the key terms of investment will certainly relate to how much equity you are buying, how involved you expect to be in advising and guiding the company, the current stage of the company, and the future capital intensity. Many angel investors prefer capital-efficient ventures, ones that can quickly reach sustainable, profitable, and rapidly growing revenues. These tend to be businesses based on significant innovation and disruption. Less appealing are the ventures that require tens or hundreds of millions of venture capital, as is common with consumer and retail businesses, which must buy their customers until they reach max scale. Capital intensity has a significant impact on probability of success, time to exit, and frequently limits the returns available to angels. Investing in a venture that is pre-revenue and likely to need millions more of investment capital requires that you take very simple and vanilla investment terms, unless you are certain of being the source of most of that future capital. If you take aggressive and highly privileged terms of investment, they become a barrier to future investors, and they reflect badly on both your skill as an investor and on the founder's commercial acumen. Founders are always eager to move quickly, but beware. Speed is not always your friend when you are trying to validate the opportunity and working to establish a relationship that is likely to last at least 5 years, even longer if the company is a huge success. Remember the old saying, act in haste, repent at leisure. On the other hand, taking too long can be just as bad. Remember, we discussed the need to build a portfolio of at least 10 concurrent investments. If you can, you would be wise to build a bigger portfolio. But remember that quality is always more important than quantity. That is why you have defined your investment thesis. In your investment thesis, you will have considered your model for post-investment engagement. And again, the research shows that just as with due diligence before investing, doing a good job of engagement after investing has the biggest impact on your returns. But can we do all of this in Australia? Can we actually be successful doing this in Australia? Absolutely. A great example from the Melbourne Angels portfolio is Rome to Rio. This company was founded by two very clever young men committed to the idea that they could build in Melbourne a world-leading tech company that would dominate the global market. They did exactly that, defining and dominating the global market segment for multimodal travel planning. And they did it with just 2 early rounds of modest angel investment and a strong focus on over-delivering on their value proposition to their customers. The result? After 6 years, the company was sold to a German online travel conglomerate. A very satisfying return to the investors and, of course, an even more satisfying return to the founders. But it gets better than that. Rome to Rio continues to operate in Melbourne under its own brand, growing its core business, employing more people, paying local taxes, and enhancing the reputation of Australia. The Melbourne Angels member, who was a director and had served as chairman of Rome to Rio, was encouraged by the acquirer to remain on the board, which she has done. This is what we want to see. Companies that do something entirely new, open new markets, create new jobs, and drive significant export revenues, all from an Australian base with the support of angel investment and advice. To build your portfolio can be expensive in dollars, time, and the opportunity cost against all the other things you want to do in life. An angel group offers you 3 things that lie at the core of realizing an effective, successful, and enjoyable portfolio of startup investments. First, when you join a group, you get access to the deeper financial resources of the collective, and thus you're able to invest a little bit less per deal and therefore in more deals than you would be likely to do on your own. This diversification by volume is the first primary risk mitigation strategy of any investment portfolio. Most people are astute enough to know they want to invest in the things they understand. No matter how experienced we are, nor how much we know, each of us is only likely to be deeply confident in a relatively narrow range of business opportunities. On our own, we're challenged to find all of those very best opportunities within that narrow scope. When you join an angel group, you benefit from the depth, breadth, and diversity of the expertise, experience, and networks of all the other members. Thus, you're able to invest in a greater range of businesses than you are likely to have done on your own. This diversification by scope is the second primary risk mitigation strategy of any investment portfolio. Now, in theory, you could do both those things on your own. That is, you could make more money and you could learn new stuff. In practice, it may not be so easy. But the third thing that you get with an angel group, you can get no other way. The third benefit of a group is time. The whole process of sourcing and evaluating opportunities, remember that 100-to-1 ratio I talked about? Negotiating investments, coaching founders, supporting exits. It all demands a wide range of skills and a lot of time. When you join an angel group, you get to learn and refine your skills through practice and training with experienced colleagues. When you join a member-led angel group like Melbourne Angels, you benefit from the time of all the other members. The collective, collaborative effort of the group is what gives you the time to learn, the capacity to process the volume of opportunities, and perhaps most importantly, the chance to enjoy it all, to have a bit of fun. Melbourne Angels has invested in more than 75 companies in over 600 individual investments. Typically, We invest in pre-revenue ventures at a key value inflection point. That's usually revenue, but it depends on the sector and business model. For portfolio companies that are succeeding, it is not uncommon that we support them through 4 or 5 rounds of investment. Successful companies in our portfolio today are currently valued at 10, 20, and even 40 times our original investment value. More than 13% of our deals produce exits, which include trade sales, like Rome to Rio, ASX listings, script-based mergers, debt redemptions, and of course, some simple shutdowns. We have 1 or 2 pitch meetings every month at Melbourne Angels. Our members on our screening team meet every week to complete that triage, to compare notes on the founders that they are coaching, and to select the opportunities for pitching to the whole group. Our membership team delivers the best angel training workshops in Australia throughout the year, and every member has access to an extensive array of online training and reference materials. The members on our investment team are an expert resource within the group to support our screening team, advise our deal leads, sanity check our investment terms, and guide our portfolio engagement. To start angel investing, you should be able and willing to invest at least 1 or 2 investments per year for 5 years to develop that concurrent portfolio of 10 investments. Now, depending on your circumstances and your investment thesis, you may well invest at a much higher rate and for a much larger portfolio. An angel group should provide you with the volume and diversity of deal flow to enable you to build that portfolio. Melbourne Angels typically does around 20 transactions a year, more than half of which are first-round investments, while the balance are follow-on rounds, supporting our successful portfolio companies. Investing in startups, the people are both the most important and the hardest piece of the puzzle. The diverse experience and skills of an angel group are invaluable in effectively and efficiently evaluating the founders and their teams. Angel investing is focused on aligning our interests with those of the founders, an alignment towards shared future success. The angel group process and legal documents are all designed to achieve that alignment. Usually in an angel group, you decide which investments you'll make and how much to invest. The collaborative process ensures all the angels share the due diligence, invest on the same terms, and contribute to supporting the portfolio companies. In a member-led angel group, like Melbourne Angels, the members do the work of organising our events and running the group. At Melbourne Angels, our members are active in the startup community as founders, business leaders, mentors, advisors, and more. Our training workshops are designed for Australia, created and delivered by internationally respected angel investors. These workshops are free to members, open to other startup investors, heavily discounted for founders, and available to anyone interested to learn the art and skills of investing in startups. In fact, it's not uncommon for more than 1/3 of the participants in our workshops to be startup founders. At Melbourne Angels, you will find a professional, collegiate, and ethical community of like-minded peers. Joining an angel group can't guarantee you will make a great investment. It can help you avoid the bad ones. It will most definitely allow you to enjoy the fun and adventure of investing in startups. If you want to be an angel, or if you've already started on your own, please contact us at Melbourne Angels to join our welcoming, supportive, diverse, and inclusive community. I look forward to investing alongside you.